Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today in our call, we have CEO Paul Ghezzi from Kontrol Energy. Kontrol trades on the NEO exchange under the symbol KNR and on the OTC under KNRLF. The company is trading at $1.70 with roughly 48 million shares outstanding, or about an $81 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Great to have Paul back. We've had Paul on a couple times. Most of you guys will probably, Kontrol Energy fairly well. But what we always like to do is when we have somebody back on, we like to ask for a brief summary and a description of the business for those that don't know what Kontrol Energy does. So Paul, great to have you back. And please let us know again what Kontrol Energy is all about.
Yeah, thanks to be back. So just a quick correction. It's Kontrol Technology now. We changed
there you go. Yeah,
that's okay.
Yeah.
But we do operate, one of our subs is Kontrol Energy, so that's still good. So we're in the smart building technology sector. And the way I define that is by the problem. In the next 10 years, buildings are going to consume about half the world's energy and emit about 40% of the greenhouse gas emissions. So we're tackling that building by building through software, service, and projects, which basically make buildings more intelligent, more sustainable, and healthier.
Perfect. Now, two sort of trains of discussion here. You last year when we got hit by COVID, you announced some really cool technology called BioCloud. Why don't we start by just describing what BioCloud does and whatever updates you can possibly give us.
Yeah, so it was around this time that we announced our first results of our prototype. And BioCloud is an area monitor. And what it's doing is sampling the air in real time, looking for viruses and pathogens. And of course, the primary virus that we're looking for these days is SARS-CoV-2. When we designed the technology, it was really for multiple future applications with a focus on the current pandemic. So I would say it's been an interesting year of ups and downs for BioCloud, but we're in a really good place right now with a major partnership just announced with Steelcase. And for the investing market, Steelcase is an NYSE listed stock, about 2.6 billion of revenue, 800 dealers. So that takes our dealer network from where we are from 20 to 800 overnight, which is really amazing. And, we came to the conclusion that we can't be everything to everyone. So we were working to build our own dealer network, working on the technology, working on sales. We really said, look, what are we good at and what should we be partnering on? So that took about 10 months to bring that together, but it does a 40x for us on our dealer network. So we're excited about that.
Mm-hmm. Now, pretty interesting. So this machine has the capability of detecting small amounts of in this case, COVID, but in theory, it could be any sort of infectious or transmissible disease. Where are you in terms of commercialization? You've got distributors in place, but now, are you selling the product? If so, how much? Give us a sense of where you are.
Sure. So the technology is really based on something that everyone in the science and lab world is familiar with, called the modified Western blot. So we've taken what you would do in a lab, and there are some companies that'll come to your office, take a sample, send that sample to the lab, comes back to you in a couple of days and says, here's what's in the air. We've taken that process, which is now fully automated inside the BioCloud, and we do real-time sampling of air in a setting. So we cover about 1,000 square feet, and the BioCloud is really meant to register at levels below viral shedding or spreading. And the concept there is, think of it as a smoke detector or a fire alarm. We want to know the room is safe because we're sampling the room in real time. From a distributor perspective, we've just added Steelcase. Prior to that, we had 20 distributors and global distributors in nature. So we have South Korea, Australia, Europe. And in terms of that network, we're selling to our distributors. We don't segment our BioCloud revenue separately out of our total revenues. But we can say we're selling the product. It's adding to revenue. It's adding to the bottom line. And with Steelcase, we have a really amazing opportunity here across North America as we head into the fall with the Delta variant. And so one of the things that we do with our technology, which is quite unique, is we use antibodies to interact with the virus. We purchase our antibodies from third-party manufacturers. So part of our technology is mechanical in nature, part of it is chemical as we automate that process. But when we purchase antibodies from third-party suppliers, they have already validated against the Delta. So it's an interesting position for us here where everyone's going back to work or wants to go back to work. You have the Delta virus causing some havoc, and we've got the Steelcase partnership. So timing looks really good for us.
Mm-hmm. And if refresh my memory, I believe there's a hardware sale and there's a sort of cartridge sale. If there's a test positive or if, detects COVID, it's you're going to have to rechange the cartridge. Is that not correct?
Right. So in general, think of the outer shell, the technology, the computer processing chips, the software as the unit. And the unit is really designed for 10 years of life or more. What's consumable is the virus that we're looking for, the detection chamber, like a Keurig system. That's specifically designed for SARS-CoV-2. So when we come into contact with the virus, that needs to be replaced. However, in the future, if it's not the SARS-CoV-2 virus, 3 years from now, it's something else, we'll have a cartridge in the same physical hardware. So it gives us really long life beyond this current pandemic, but also allows us to focus on the current pandemic with the technology.
Fantastic. Let's jump into your numbers. You just came out with Q2 numbers. Really nice bump in revenues, 4.2 million revenues, up 83%. What's happening?
So, last year, I would say it's two things. Last year was a really tough year, but we still managed to end the year EBITDA positive. And we pride ourselves on some of that financial discipline in the business of managing the spend and managing the balance sheet. So what we really had is a good recovery off of last year, some good organic growth. And then we have just announced an acquisition at the end of July that should take those numbers from last year and triple them. So we're in a really good spot here. We had record EBITDA. Balance sheet looks really good. We just completed institutional financing, I think at $1.50. And so we've got lower interest costs, cleaner balance sheet, more revenue, good earnings, and a really nice acquisition that adds approximately 20 million this year, roughly. And next year, we should double from this year. So we're in a nice spot here. And it's a combination of all those things coming together and, managing through the pandemic, which was a pretty tough year for most companies last year.
No doubt. Okay, so you mentioned the acquisition. There's a company called Global HVAC, if I'm not mistaken. What do they do? Is it something different than what you guys do, or have you sort of added on more girth to what you do?
Right. So we deliver our broader technology services and solutions to our customers as software, service, and projects. And Global would be on the project side. So one-time large projects that lack really any software platform and any service platform. So the reason we like that business is one-time projects that can turn into recurring revenue over time. If we can insert our software platform and our service business in there, we can start to build up higher margins than a project business. So what we looked for in that acquisition is the valuation right, and can we integrate the business with the rest of Kontrol? And that deal took about 12 months to put together. So we're very happy with the top line, and we're going to be adding service and software to drive that bottom line.
Synergies there for sure. Back to what you said earlier. So you did do a financing recently. I think it was $8.5 million. Cleans up your balance sheet. I see that you paid down to $3 million in debt as of your last press release here. Give us a better sense of where you guys are now in terms of balance sheet. What's your debt look like right now?
Sure. So we've got about $7 million of unsecured debt. And perhaps more importantly, not convertible. And by being not convertible, there's no dilution there. Reasonable coupon. I think we've got another a year and a half on that. And so we're in a really nice spot here. Debt to equity looks really good. Interest has come off. We've also had some convertible debentures that have converted. And so that part of the balance sheet is cleaned up as well. So the structure is looking very good. We've always used debt to grow. But in an environment like this, we felt it was prudent to reduce some of that, have a strong balance sheet, execute on the business, and really look for the next opportunity to grow, which is both organic and acquisition.
So that sort of leads to my next question. More to that is, are you still on the hunt for any other acquisitions?
We always have about 3 or 4 that we're looking at as a stable. Mm-hmm. And the reason we do that is, you may not do a deal. So a couple of years ago, we didn't do any deals. Mm-hmm. This year we've done 1, and next year we may not do any. But the idea is to always have a good stable of acquisitions. And what we really look for is customers and cash flow. Mm-hmm. We're not interested in buying technology. All the technology is going to be developed in-house. And the reason that works for us is you tend not to overpay for customers and cash flow. You tend to overpay for technology. Mm-hmm. And it ends up showing up in your balance sheet and your earnings eventually. You might be able to run with it for a while. So typically our acquisitions are done at about 4 times EBITDA, which is a very attractive valuation. If you use a revenue metric, that's 0.3 to 0.45 times revenue. And then the natural arbitrage in our stock, should be much higher. So the way we look at it is we're looking for deep value, good value, synergies with the business, and not to overpay.
So can investors anticipate that you're going to look at other deals similar to Global HVAC, sort of geographically expanding but still more on the project basis?
Yeah, that's a really good question. So what we're really interested in now is our market tends to be regional and private. Mm-hmm. That's primarily where our competitors come from. Mm-hmm. So the next kind of round of companies that we're interested in are more on the service side, with good recurring revenues, high margin, mm-hmm. but in different regional markets. We think we have the Ontario market, fairly well covered right now, mm-hmm. Very well diversified and integrated. We're now looking to expand out east, out west, and we're looking at the east coast of the US as well.
Gotcha. I also noted that this goes back to BioCloud, but you guys also received, looks like $800,000 from the Ontario Together Fund. Maybe give us some more color on that money.
Sure. There were really 2 sources of funding for BioCloud. There was $500,000 from the federal government through the National Research Council, so that was completed. Mm-hmm. And there was $2 million from a specific fund in Ontario called the Ontario Together Fund. And that is really COVID technology funding outside of specific vaccines. So we're very proud that we were able to pass all the hoops and hurdles to get in and validate the technology. And then the funds were dispersed in 2 tranches, 1.2 million up front, and the balance of the 800K if we met all the milestones. So we have that agreement filed on CEDAR. We met all the milestones and received the final 800K. So that ended up being 2.5 million into BioCloud development, which for our shareholders is really great value. It represents non-dilution and participation by the government.
Right. No, fantastic. Another thing let's go back to BioCloud a little bit more and maybe just COVID in general. Last year was a pretty challenging year for anything that was sort of service-based. You felt some of that early on. You've got the potential really big upside from BioCloud, but how do you see COVID continuing to affect the business going forward?
It's a really interesting kind of paradox. So the reason we actually started developing the BioCloud is we were having a big challenge getting into facilities. We were in this prolonged shutdown. Mm-hmm. And the government approach back then was to continue to shut down and not allow site access. So we asked the question, could we develop an area monitor that could assist in opening up the economy? And really that premise is still true. It's an early detection system that should help do that. So I think, what we've gone through here is a cycle of the BioCloud technology was developed pre-vaccine. When the vaccines came in, really for about 6 months, it was vaccines 24/7. It's really hard to fight that news cycle. And that became the narrative. The second narrative was the virus is gone and we're good. Let's all get back to work. So now we're in a situation where we know that roughly 70% of the population is vaccinated, roughly 30% may never be. We know there's variants and strains, and we know it's not back to normal as it was. And the vaccines are a great technology, but only one technology. So BioCloud represents a layered technology approach where we're supporting the ecosystem. And really the question we're answering, can I go into that space and is it safe? And if we think about today, employers versus employees, it's a fundamental question that needs to be addressed. And we think we can help solve that. So I think, it's been a roller coaster for anyone who's really been affected by the pandemic, but more so if you've had a technology that could assist in the pandemic. On the other side of our business, we've seen kind of renewed interest in core technologies that can help with air quality, running a better building. You know, the commercial real estate sector is struggling. So how do we get more technology to reduce costs? So I think in some ways, interestingly enough, we've benefited from some of the challenges outside of last year where we couldn't get into site. And right now, site access is fairly good. And we hope there's no more shutdowns and that we can start using a technology approach to getting back to normal.
Listen, I want to remind everybody who's listening today, if you've got any questions you want me to ask Paul, please feel free to use the chat function and I'll do my best to ask him. Let's stick with a question around challenges. Any other challenges you guys think you're facing, or what keeps you up at night right now?
So I would say, you know, the big lesson for me, and I think every small cap CEO faces this, is you have your business and you have your public company stock. Mm-hmm. And in some ways, you know, when you're a large cap, they're the same business. But when you're a small cap, they're actually two different businesses. So, you know, one of the things we think about a lot is managing the capital side of the business, or the public side, and managing operations. And I think on the capital side, there's always a lot of volatility for small caps. Mm-hmm. How do you navigate that? How do you manage it? You know, how do you execute in that environment? On the business side, it's always about, you know, can you grow fast enough? Can you grow faster? Can you execute into that growth? And can you manage your P&L while doing it? So I think those are really the things we think a lot, you know, about. And certainly when I go to bed, what I think about.
Now, on the capital markets side, I noted you moved your listing to the NEO exchange. Tell us more about that.
Sure. So that what was really attractive to us about the NEO was a couple of things. One, it's a senior exchange. It's really well recognized in the US. They've created their brand around being the NASDAQ of the North, and institutionally it's well received. So really what I was looking for as an issuer and also a shareholder was more transparency in the trading. The NEO uses something called a high frequency algo speed bump, which is basically meant to slow down high frequency trading and give the average investor a better chance. And that to me is appealing. And I think, you know, every shareholder should have the same chance as any fund to either buy or sell stock. So that combined with the transparency and being a senior listed issuer was very appealing. So it was time to graduate from the CSE. You know, we're happy. We went public on the CSE and we were pleased with that in terms of our growth. And this was really just a graduation for us.
We've got another question here. I might as well ask it now, but back to sort of your core business, what is your competitive advantage? What makes you different than your competitors?
So that's a great question. So if we think about the way our industry is structured, you have the mega caps like Honeywell, Johnson Controls, you know, Siemens, Schneider, that are global in nature and tend to run global programs. Then you have what we basically compete with is a regional and private market against regional and private operators. So what we've done is we've created a unified platform based on software where we're going in to a building, and typically a customer of Kontrol would be a 40,000 square foot building and above. We overlay our software into the building and the building automation system, and we use all that data to build out services and solutions. And what's not happening in the industry and where we have an advantage is that unified platform is lacking. It's a very fragmented, you know, number of solutions, number of providers. And by aggregating and creating that unified platform driven by software, we're able to gather market share. And the way we think about market share is get more of the building, the value in the building that we can get, and then get more buildings from our customers. So part of it is organic growth. Mm-hmm. Part of that is driven by acquisition.
Mm-hmm. I've seen so much discussion about how to, you know, bring more and more technology into buildings and you know, turn them into smart buildings. Maybe give us a sense of, you know, you're sort of seeing it firsthand, but some of the innovations that you're seeing around new buildings and the data collection and all the stuff that's happening.
Yeah, so it's an interesting market because it's attracting a lot of startups and the startups on the software side. And so if you think about the way a building uses energy, let's say 70% of energy consumption is driven through heating, cooling, ventilation, and then you've got, you know, 20% ancillary utilities, and then, you know, the way people use the building, lights, etc. So initially there was this big push to get everyone on LED lights. That was the innovation, but LEDs only have about a 10% impact on the overall building. Where the innovation is coming now is everyone's recognized that if you're not dealing with the heating, cooling, ventilation systems, you're really missing the big part of where you can influence. So we're seeing a lot of software incumbents come in where it's really about having more control over the system, trying to insert more automation, more technology. What we find for us is the software players don't have enough scale to compete with us on a regional basis. And we're really not bumping into the large global players. So really, if you can add good technology around the HVAC system and more controls, more automation, more reporting, more data, that also drives lower GHG emissions, which is now becoming a big deal because most Fortune 1000 companies have a net zero 2050 policy. That ties into sustainability, and that's why Morgan Stanley refers to this period as the commercial building super cycle for technology. They've actually defined the next 10 years as this technology kind of pouring into buildings. The other side of it that we see, which is really interesting, is if you've been impacted by vacancy rates, let's say your vacancy rate is higher, and maybe you're not going to get some people back into the buildings, well, you better have a lower operating cost to offset that. So moving from a 2% vacancy to a 10% can be lethal because that's where all your profit is. Mm-hmm. You've got to find ways to make the building more efficient. So lower maintenance costs, lower energy costs, lower service costs. So all that's playing into this cycle as well. It's not just about energy, it's about getting a lower cost to operate the building.
Yeah, I've spoken to a few commercial operators, and getting a 1 or 2% reduction in sort of operating costs has a pretty massive impact on the value of the building. So they'll drive whatever incremental, even small incremental advantage they can. So I can see it. No, that's fantastic. So I notice you're giving forecast now. In the press release, you announced that you're forecasting $38 million in revenue for 2021. I think 3.7 million adjusted EBITDA. How do I say this? Like, give us a sense of like where are you guys going to be in 5 years from now? You know, and how do you get there? You know, M&A, organic growth. Give me the 5-year plan for Kontrol Technology.
Sure. So those are the numbers for this year. What we've put out is some numbers for next year, which are about double those numbers, which is really based on the core business, the acquisition, BioCloud. The way we think about, you know, our business, it's really interesting. You've got the mega caps in the public market. You don't have many mid caps and small caps. And the reason that is once you get to a certain size, you're typically acquired. And so, you know, I think Honeywell is running at about 50 billion of revenue, you know, same for a number of its competitors. And if you get to scale and you've got technology that other people desire, that's why you don't see many public small caps or mid caps. So our view is, you know, north of, let's say, 150 million of revenue, and you're executing on your plan. And let's say you get 2 times forward on that as a valuation, which is kind of the industry standard. So you get to that 300 million market cap, you know, you're usually a takeout candidate, not 100%, but you're piquing the interest of a transaction that would interest, you know, a larger organization. So I think from our perspective, we are building the business to either be acquired in the future because it's very attractive, or we're building the business because we're focused on getting bigger. And one thing I've learned about the public markets, which is really interesting, is there's really no kind of status. Like when you're a small cap, either you're growing or you're not. There's no, you know, when you're a bank, you can take a couple of years off, right? And but in small caps, really it's about scaling the business and growing. And fast growth is rewarded. We've done it a little different. So we grow quickly, but we also focus on EBITDA. And so the idea for us is fast growth, EBITDA positive, get to that cash flow break even where you're investing back in your business. That's our model. We don't like burning up the P&L to grow because at some point you could be penalized for that, you know, if the market turns on you. So I think the 5-year vision is to grow as fast as we can, you know, grow revenue, grow earnings, reinvest in the business, and have technology that other larger organizations could desire and maybe get taken out.
Now, I remember when we first spoke, you really sort of emphasized the fact that you wanted to keep a tight structure. You know, you're a large shareholder of the company. Remind us how much insiders own of the business right now.
Yeah, so of the basic structure, 47 million, I believe it's 32% insider ownership.
Perfect.
And I would say on that, look, nobody's perfect on, a lot of that is timing. A lot of that is there's a whole market around you that's operating.
Mhm.
But I think, we've done a reasonably well job of keeping the structure tight. And if I think of, relative to kind of small cap Canada, I think we've done a good job. We've used debt to grow. Most of the debt was not convertible. We did have some convertible debt. And the idea for Kontrol is to limit dilution, but also if there's a need for dilution, make sure it's accretive. And what I mean by that is we're not raising capital because we're burning up our P&L. We're raising capital to make an accretive acquisition or invest in technology, which is what you really should do to create a return for shareholders. So you should never, there should never be this view that you should never dilute. There has to be a purpose to it. We like to think about it as what are we adding in terms of value?
Yeah.
And I think that's a question we ask ourselves a lot. And we like to look at it from the perspective, if we can add value, maybe there's a time to raise capital.
Yeah, smart dilution. No, absolutely. That's part of the advantage of being a public company is you can take advantage of anomalies in valuation. If the stock price is right, you raise money.
Right.
That's what you do. Let's talk a little bit more about the stock. Any coverage or I mean, you're still relatively small, but who's paying attention to you guys right now?
Yeah, so we're happy to share that AGP out of the US, which is a broker dealer, is covering Kontrol. And I believe they came out about a month ago with a $2 US price target. So that was nice to get that US coverage. So that's good for US institutions. And as we know, analyst coverage is a little different today. It's different, because of all the social media and the way the world, transmits information. But it's great to have an analyst covering you, and we hope to have a few more in the coming 6 months as the story gets picked up.
And what are you doing? I mean, you are a public CEO, and you talked about capital markets, but what do you do for IR right now? What's working? What's not working? How do you get people to pay attention?
Yeah, that is the fundamental question, and it's I call it. There's really two things going on. It's competition for capital. And competition for eyeballs, meaning that, who's paying attention to your story. And so we've kind of taken, we've learned the hard way kind of what to do, what not to do from when we started our journey. And I used to have this mentality, I would say up until a year and a half ago, just build your business and everyone's going to know who you are. And it just doesn't, because it's such a noisy market, it just doesn't really work that way. So what we've done is we've worked with a number of good firms. We decided to make the transition into the US market. And so now we run our IR to the US. And the logic for that is the market is so large. I mean, there's so many broker dealers. There's a huge retail network. Let's tell our story. Let's have the US as our main platform, and then, Canada as our secondary. And I think that's really paying dividends now. So we started that a number of months ago. It was slow out of the gate because you've got to meet funds a couple times, get to know them, meet investors a couple of times, but the story is being disseminated to a much broader market. So I think as a learning experience, never shy away from the US because it's a very large market. And the other thing is, create a good social media presence, try and communicate with your shareholders through press releases, but also once in a while, an update here or there, conference calls. And so again, we're not perfect, and maybe there's groups that do it better than us, but we try and have what we call kind of a broad approach, multifaceted, and then really, you can do all that, and if you're not performing, it's not going to help you. So we do spend a lot of time in the business, working to grow the business and execute, so that when you are telling your story, it resonates and people stick around. But yeah, it is a great question, because it's the question that every CEO asks is, where are all the investors? And so it's really, in my view, it's multifaceted and multi-layered.
Yeah, no doubt. Well, listen, I mean, I think we've covered a lot here. Certainly, you've answered all the questions I've got right now, and looks like we've done a good enough job where not too many questions from the listeners, so that's a good sign. I always like to give these opportunities, but Paul, any sort of key takeaways or key message you want investors to leave today with?
Yeah, so we are excited about our future. We're excited about our innovation, and we're excited about our last acquisition. I think you're seeing some of that in our performance. Sometimes in the market you can be ahead of execution, sometimes you can be behind it. So I think the market's catching up with where we're going, And we look forward to sharing more news in the coming weeks and months.
Fantastic. Now, if somebody wants more information, remind us what's your website address, or how best should they get more
Sure. So it's
information?
www.kontrolcorp.com, control with a K, kontrolcorp.com.
Perfect. We've been speaking to Paul Ghezzi, CEO of Kontrol Technologies. Paul, it's been great to see you again. Thank you so much for the update, and congratulations on the recent quarter. Clearly, the market's woken up. I saw the stock perform nicely today. So continued success, and we look forward to catching up in the near future.
Thanks for your time.
Awesome. Thanks a lot.